In 2020, China did something no major economy had done before. It deployed a digital currency directly into the financial system of a nation of 1.4 billion people, not as an experiment, not as a pilot, as infrastructure. The digital yuan moved through Shenzhen, through Beijing, through the provinces. Millions of transactions. By 2024, the volume had crossed 1 trillion yuan. That is equivalent to moving the entire annual GDP of Mexico through a digital ledger in a single year. Western observers watched this and asked the wrong question. They asked, is China trying to challenge the dollar? But that question misunderstands what actually happened. China did not challenge the dollar. China built an alternative to it, and in doing so, they revealed something that every other central bank on earth is now quietly confronting. Not the problem of American dominance, the problem of their own future. Central bank digital currencies, or CBDCs, are not cryptocurrency. This is the critical misunderstanding that has obscured what is actually occurring. A cryptocurrency is decentralized. It operates without a central authority. It moves based on cryptographic proof and distributed consensus. A CBDC is the opposite. It is centralized. It is issued by a nation's central bank. It is controlled completely by that central bank. Every transaction is visible. Every holder can be identified. Every movement can be tracked in real time. This distinction matters because it reveals what CBDCs actually are. They are not modernization. They are not merely digitization. They are the replacement of cash with a system in which every financial action is observable by the state. For nearly 2 centuries, fiat currency existed in a physical form. You could hold it in your hand, you could spend it without recording it, you could save it without anyone knowing you had it. This was not a feature intended by central banks. It was a byproduct of the technology available. But it created something that no amount of economic theory could have designed. A space where citizens had financial autonomy, not absolute autonomy, but real autonomy, enough to resist. CBDCs eliminate this autonomy entirely. Here is how they work at the mechanical level. When you hold a dollar bill today, you hold an object with no creator identification. You can spend it. No one monitors the transaction. The person who receives it holds an identical object. The transaction is complete. The ledger is updated at the Federal Reserve, but the link between you, your identity, and that specific dollar is severed immediately. With a CBDC, this breaks down. Every unit of currency is digital. Every unit exists as a record in a central database. That database is controlled by the central bank. When you receive a CBDC, your central bank knows. When you spend it, your central bank knows. When you hold it, your central bank can see the exact balance, down to the fraction. They can see every transaction you have ever made. They can see where the money came from and where it went. This is not paranoia. This is the stated architecture. The People's Bank of China has published technical documentation for the digital yuan explicitly describing this level of observation. The European Central Bank has discussed the same capabilities for the digital euro. The Federal Reserve has published papers on programmable features for a digital dollar. These are not hidden goals, they are listed capabilities. But the observation layer is only half of what makes CBDCs revolutionary. The other half is control. With a CBDC, money becomes programmable. This phrase has been used so often that it has lost its weight. But consider what it means. With current cash, once money is in your account, it is yours. You can spend it on anything. No restrictions, no conditions. A CBDC changes this. Money can be issued with expiration dates. Spend this digital currency within 30 days or it disappears. Money can be restricted by purpose. This CBDC can only be spent on food, not fuel, not entertainment, not savings. Money can be restricted by geography. This digital currency is valid only in this province, not in that one. Money can be restricted by recipient. You can spend this only at this specific vendor. Some of these features are framed as consumer protection. Imagine a government wanted to help low-income citizens. It could issue digital welfare in a CBDC format that could only be spent on nutritious food, not junk food. The paternalism is wrapped in kindness, but the mechanism is absolute control. The Federal Reserve has published research on expiring money. The technical mechanism is simple. Every unit of digital currency could have a timestamp. After a set period, it becomes worthless. This solves a problem that fiat currency has always had. People save. Savings reduce velocity. They reduce consumption. They reduce tax collection. An expiring CBDC would eliminate saving. If your money disappears in 30 days, you must spend it. This would increase velocity dramatically. It would increase tax collection because more transactions occur. It would increase the power of monetary policy because the central bank could adjust the expiration period in real time. Negative interest rates, which have been technically impossible with cash, become trivially easy with a CBDC. You hold 100 units of digital currency. Tomorrow, 95 units remain. The central bank did this with a single keystroke. Your savings were taxed. You have no recourse. You cannot withdraw cash because there is no cash. You cannot move to another system because all systems are CBDCs. You cannot hide the money because every unit is tracked. These are not theoretical concerns. These are real technical capacities that central banks are discussing openly. Now here's where the story becomes complicated. Central banks are building CBDCs primarily for one stated reason: to escape dependence on the dollar. This is the secret that no one talks about publicly, but every central banker whispers privately. The dollar system is efficient, but it is controlled by the Federal Reserve and the United States government. If you hold your reserves in dollars, you are subject to American sanctions. If you conduct trade in dollars, you pass through American payment systems. If the United States decides you are an enemy, your access to the dollar system can be terminated instantly. This has happened repeatedly in the last 2 decades. Russia was removed from SWIFT. Iranian reserves were frozen. Venezuelan gold could not be accessed. Every central bank in the world has noted this. The calculation is simple. The dollar gives us access to global markets, but it gives America a veto over our financial system. A CBDC gives us a veto-proof alternative. We can create a digital currency that our citizens and trading partners use. We can conduct trade in our own currency. We can bypass the dollar entirely. This is true. A CBDC system that operates between central banks, settling in their respective digital currencies, can exist without the dollar. China and Russia have discussed this. The BRICS nations have discussed this. Even the European Union, which is nominally aligned with the United States, has discussed building a digital euro specifically to reduce dollar dependence. But here is the trap that no one discussing this seems to notice. Yes, CBDCs permit escape from dollar dominance, but they do not permit escape from financial surveillance. They merely transfer control from a foreign power to a domestic one. A Chinese citizen using the digital yuan can evade American sanctions, but they cannot evade Chinese government observation. Every transaction they make is visible to the People's Bank of China and, by extension, to the government. The same applies everywhere. An Indian citizen using the digital rupee escapes Federal Reserve dominance, but submits to complete observation by the Reserve Bank of India. A European citizen using the digital euro gains independence from the Federal Reserve but surrenders financial privacy to the ECB and national governments. The irony is brutal. Central banks are building the infrastructure to escape American financial hegemony, but in doing so, they are building perfect infrastructure for their own governments to achieve absolute financial control over their citizens. The solution to external coercion is internal total surveillance. This is not accidental. It is structural. There is no way to build a CBDC that is simultaneously globally functional and does not permit observation. The two properties are linked. If you want a currency that can be used for trade between nations, that currency must be identifiable. If it is identifiable, it can be tracked. If it can be tracked, the central bank can observe it. If the central bank can observe it, the government can control it. This creates a peculiar moment in financial history. Central banks are racing to build CBDCs because they want independence from the dollar. But independence from the dollar does not mean independence from surveillance. It means shifting surveillance from an external actor to an internal one. In many cases, this might be preferable. Americans are not citizens of other countries. American observation of Russian transactions is a foreign threat. Russian observation of Russian transactions is a domestic issue, a matter of internal governance. But the mechanism remains the same. With a CBDC, the central bank has absolute visibility and control. Cash disappears from the system. Alternative currencies, cryptocurrencies, foreign currencies, precious metals become the only escape routes. This creates a new form of financial repression, not the old form where banks force you to hold their currency through monopoly, but a new form where your own government forces you through elimination of alternatives. Consider what happens in a fully CBD-sized society. A citizen is unemployed. The government provides digital welfare in CBDC form. That CBDC can only be spent on specific items. The citizen cannot choose to save it for a better opportunity. The CBDC expires. The citizen cannot choose to leave the country with their savings. All currency is digital and trackable. The citizen cannot choose to buy assets outside the system. All assets are registered, all transactions visible. The citizen cannot choose dissent if dissent might result in financial restriction. The threat is not explicit. The threat is permanent and structural. This is not unique to China or authoritarian systems. Democratic governments face the exact same incentives. A wealthy person in a democracy who disagrees with government policy could, with cash, move their money outside the system. With a CBDC, the central bank sees every transaction. The government can legislate restrictions. You cannot move your money across borders without government approval. You cannot spend money on organizations the government dislikes. You cannot save more than a permitted amount. None of this requires legislation that appears obviously tyrannical. It all happens through technical restrictions built into the currency itself. Some proponents of CBDCs argue that these mechanisms could be restricted by law, that democratic oversight could prevent abuse, but this argument ignores how power structures actually work. Once the technical capacity exists, the political pressure to use it becomes irresistible. Crime exists, so surveillance becomes justified. Tax evasion exists, so transaction monitoring becomes justified. Terrorism exists, so asset freezes become justified. One by one, the safeguards erode. What is occurring is a bargain that central banks are striking with their populations, often without the populations understanding what is being traded. You get independence from external financial coercion. You escape the risk that a foreign power will sanction you or freeze your assets. In exchange, you surrender financial privacy and autonomy to your own government. Your own government will know everything about your financial life. Your own government can restrict what you can buy and where you can save. Your own government can expire your money and force you to spend it. The de-dollarization story that dominates headlines is real. CBDCs will in fact reduce dollar dominance. Countries will trade in their own digital currencies. The SWIFT system will become less central. The Federal Reserve will have less leverage. But what replaces it is not a more open, more distributed, more free financial system. It is a more controlled, more centralized, more surveilled system. Each nation will have perfect visibility into the financial lives of its citizens. Each nation will have perfect control over monetary policy, not through interest rates and quantitative easing, but through direct manipulation of the money supply itself. This is not a conspiracy. It is the stated technical direction. The People's Bank of China has published papers on programmable currency. The European Central Bank has discussed spending limits and expiration dates. The Federal Reserve has researched negative interest rates through digital money. These are not hidden agendas. They are published research directions. The tragedy is that the problem they are trying to solve, dependence on the dollar, is real. But the solution they are building creates a different problem that may be worse. Dependence on the dollar is external control. Dependence on your own central bank's CBDC is internal control. It is total, it is inescapable, and it is being built right now, justified as progress.